Hi, hello, welcome to all of you. This is Dr. Manjunath N, Assistant Professor from Department of Commerce and Management Studies of Government First Grade College, Srinivaspur. This session is particularly designed to BBA 5th semester students of Bangalore North University. In this session, we are going to deal with the subject called investment management. The topic for the session 31 is capital asset portfolio model. Before going to discuss about the capital asset portfolio model, let us understand which are all the concepts that we discussed in the previous class. We have discussed about the capital asset portfolio model as an introduction part in the previous class. The learning objectives of this chapter is to understand the portfolio management framework and apply the various theories of portfolio management in designing a portfolio. Once the student attends this particular session, he or she will be able to understand the benefits of capital asset portfolio model. And also disadvantages also we are going to discuss in this particular session. Now let us understand what are the various benefits of capital asset portfolio model. First benefit of this capital asset portfolio model is risk adjusted return. Capital asset portfolio model provides a reasonable basis of estimating the required return on an investment after taking into account the risk inbuilt into the investment. Hence, it can be used as the risk adjusted discount rate in capital budgeting. Second benefit, no dividend company. This method is usual in computing the cost of equity of a company which does not actually declare any dividend. The other one is undervalued or overvalued stocks. The capital asset portfolio model is not only an academic model, it can put to practical use to decide whether one should buy, sell, or hold shares by comparing the required rate of return with the unexpected return. Similarly, we have fourth benefit, analysis of risk of project. The investment is risky project having real assets can be evaluated of its worth in view of expected return. Like that, we have another benefit of the CAPM, minimization of risk. That is, capital asset pricing model suggests the diversification of portfolio in minimization of risk. Like that, we have limitations also with respect to capital asset pricing model. Here we could see four limitations or disadvantages of this model is reliability of beta. A statistically reliable beta factor might not exist for the shares of many companies. Since beta is at the heart of capital asset pricing model, it may not be possible to figure out the cost of equity of all companies using capital asset pricing model. Further, all the limitations that apply to beta factor applies to capital asset pricing model as well. We have another limitation of CAPM model, that is other risks. By concentrating only on systematic risk, other aspects of risk are excluded. These unsystematic elements will be of relevance to those shareholders who do not hold a well diversified portfolio. Another limitation of this model is end and not means. The model focuses only on return and not how return is earned. It assigns equal prominence to both capital gains and dividends, whereas one may be better than the other on account of differential taxation. The another limitation of this capital asset portfolio model is information collection. It is difficult to determine some crucial information such as risk-free interest rate and the expected return on market portfolio. For one, there are multiple risk-free rates, and for other, markets are volatile and it vary over time. So, in order to understand this capital asset portfolio management or capital asset pricing model, both are same. Here, let us understand in brief about this capital asset portfolio model, and this particular model uh, gives an idea of how to decide the investment strategy. Modern portfolio theory pros- proposes low rational investors will use diversification to optimize their portfolio and how a risky asset should be priced. The basic concept of the theory are Markowitz diversification, the efficient frontier, capital asset portfolio model, the alpha and beta coefficient, the capital market line, and the security market line. Modern portfolio theory models and assets return as a random variable and models a portfolio as a weighted combination of assets. The return of a portfolio is thus the weighted combination of the assets return. Moreover, a portfolio's return is a random variable and consequently has an expected value and a variance. Risk in this model is the standard deviation of the portfolio return. Capital asset portfolio model is the extension of modern portfolio model suggested by Henry Markowitz. Capital market theory suggests us how assets should be priced in the capital markets. If everyone behaves in the way portfolio theory suggests, the mechanism explaining how assets should be priced in capital market is known as capital asset portfolio model. This model is based on the following assumptions. Number one is the investor objective is to maximize the utility of terminal wealth. The second one, investor makes choices on the basis of risk and return assessments. The purchase or sale of shares can be undertaken in infinitely divisible units. The other one, investors can short sell any amount of shares without limit. Fifth one, purchase or sales by single investor cannot affect prices. It means there is a perfect competition where investors in total determine prices by their actions. There are no transaction costs. The other assumption is the purchase or sale of securities is done in the absence of personal income tax. The other one, the investors can borrow or lend any amount of funds desired at identical risk-less rate. For example, treasury bill rates. Investors have identical expectations with regard to the relevant decisions period. The necessary decision input, their form and size. Information is freely and simultaneously available to investors. In this case, investors have homogeneous expectations of risk and returns. The investors, the, the investors needs to estimate the expected returns and variance for all securities under consideration. Furthermore, all the covariances among these securities need to be estimated and the risk-free rate need to be determined. Once this is done, the investor can identify the composition of the tangency portfolio as well as its expected return and standard deviation. At this juncture, the investor can proceed to identify return and standard deviation, identify the optimal portfolio by nothing where one of his or her differences curves touches but does not intersect the efficient set. So here the capital asset pricing model is an idealized portrayal of how financial markets price securities and thereby determine expected return on capital investments. The model provides a methodology for quantifying risk and translating that risk into estimates of expected return on equity. Dear students, let us understand the concept with few of multiple choice questions. The first question of this particular session is capital asset portfolio model be used as the dash in capital budgeting. We have four options. Option A, interest rate. Option B, risk adjusted discount rate. Option C, increased rate. Option D, price discount. Any guessing answer for this particular fill in the blank? The answer is option B, risk adjusted discount rate. Similarly, we have one more question. Capital asset portfolio management suggests the diversification of portfolio in minimization of dash. We have four options. Option A, risk. Option B, cost. Option C, profit. Option D, sales. Any guessing answer for this? The answer is option A, risk. CAPM suggests the diversification of portfolio in minimization of risk. We have one more question. A statistically reliable dash might not exist for the shares of many companies since beta is at the heart of capital asset portfolio management. It may not be possible to figure out the cost of equity of all companies using CAPM. We have four options. Option A, environmental factor. Option B, financial factor. Option C, alpha factor. Option D, beta factor. Any guessing answer for this particular fill in the blanks question? The answer is option D, beta factor. We have another fill in the blank kind of question. Dash means the model focuses only on return and not how return is earned. We have four options. Option A, end to end. Option B, end and not. Option C, beginning and end. Option D, start and end. Any guessing answer among these four options? The answer is option B, end and not. End and not means the model focuses only on return and not how return is earned. We have another kind of say, fill in the blank kind of question. In capital asset portfolio model, it is difficult to determine some crucial information such as risk-free interest rate and the dash on market portfolio. We have four options. Option A, expected return. Option B, regular return. Option C, uniform return. Option D, flexible return. Any guessing answer for this filling the blank question? The answer is option A, expected return. Dear students, I strongly recommend to go through the references which are listed in this particular slide. There are so many books are available to understand the capital asset portfolio model. So I request all of you go through these references to understand in depth about the concepts that we discussed today. And I thank you all of you for your patience listening. I wish you all the best. Thank you very much.